Hi everyone, and welcome back to our channel. Today, we're diving into a financial concept that can be either your greatest ally or your biggest enemy: compounded interest. Understanding how it works is crucial for your financial well-being, so let's break it down. So what exactly is compounded interest? In simple terms, it's interest calculated not only on the initial principal, but also on the accumulated interest from previous periods. Think of it as interest earning interest. This creates a powerful snowball effect where your money grows faster over time. How compounded interest works. Let's look at a quick example. Imagine you invest $1,000 at a 5% annual interest rate. Year 1. You earn 5% on $1,000, which is $50. Your new total is $1,050. Year 2. Now, you earn 5% not just on your initial $1,000, but on $1,050. That's $52.50. Your total is now $1,102.50. Year 3. You earn 5% on $1,102.50, which is $55.13. Your total jumps to $1,157.63. Notice how the interest earned in each subsequent year is slightly higher than the previous year. That's the magic of compounding. Over many years, this seemingly small difference can lead to a significant sum, especially with consistent contributions. Now let's flip the coin. While compounding can work for you, it's often used against you by lenders, especially when it comes to debt. The most common culprit? Credit card debt. Credit cards typically have very high annual interest rates, often ranging from 15% to 25% or even more. When you carry a balance, that interest compounds, usually monthly or even daily. This means you're paying interest on your original purchase, plus the interest that's already been added to your balance. How the system is taking advantage of you. Let's say you have a $5,000 credit card balance with a 20% APR. If you only make the minimum payment, which is often just a small percentage of your balance plus the accrued interest, you'll be paying off that debt for years, and the total amount you pay back could be double or even triple your original balance due to the power of compounding working against you. This is how lenders profit heavily from revolving debt. The longer you carry a balance, the more interest compounds, and the harder it becomes to escape the cycle. Personal loans and some lines of credit can also use compounding against you if you're not careful about repayment. The good news is, you can harness the power of compounding for your own financial growth. Here are some key accounts you should consider to make your money work harder for you. These are arguably the best vehicles for long-term compounded growth. Money invested in these accounts grows tax-deferred or even tax-free in the case of Roth accounts. And thanks to decades of compounding, your initial investments can grow into substantial retirement nest eggs. Many employers even offer a matching contribution to your 401k. That's essentially free money compounding for you. Forget those traditional savings accounts paying next to nothing. High-yield savings accounts, typically offered by online banks, offer significantly higher interest rates. While not as high as investment returns, they're a safe place to store your emergency fund and watch your money grow a little bit each month through compounding, without any risk to your principal. For those comfortable with a bit more risk, investing in the stock market through a brokerage account offers the potential for significant compounded returns. When your investments grow in value, those gains can then generate further gains, creating a powerful compounding effect. Remember, investing always involves risk, but for long-term goals, it can be incredibly rewarding. Your action plan. The takeaway is clear. Understand how compounded interest works. Make it your goal to pay down high-interest debt aggressively to stop it from working against you, and simultaneously, start putting your money to work for you in accounts that allow compounding to build your wealth over time. Thank you for watching. If you found this video helpful, please like, share, and subscribe for more financial insights. And remember, the sooner you start harnessing the power of compounding, the stronger your financial future will be.